Alright guys, this next video is to talk about tax on dividends. There's a lot of theory behind this to explain how it happens, so bear with me. But the maths is simple enough in itself. So dividends obviously are another form of income for shareholders, like capital gain. So it has to be declared as income. And so obviously, just like capital gain is an income that gets taxed, government wants to take a piece of the pie as well, so they're going to be taxing you on dividends. Until recently, so in 1987, companies paid their 30% company tax, just like we found in the Master Small Business DI. Company tax is 30%. They had to pay that 30% of tax on their profits, and then when they shared those profits to the shareholders as dividends, the shareholders also had to pay tax on the dividend income, so it was getting taxed twice. So in 1987, the dividend imputation system was introduced, and that basically prevented this double tax. Companies could then distribute franked dividends or unfranked dividends. Franked meaning the company has paid some tax or all of the tax if they're fully franked, and unfranked meaning the company has paid no tax on the dividends. So the shareholder would have to pay all the tax. The tax already paid on the dividends by the company is indicated as an imputation credit that you'll find on any dividend payment advice that the shareholder gets. So the imputation credit and the dividend are included as income for calculating the shares tax liability. You might wonder why there's a blue box around here. This is because this is the closest thing to a formula. You'd be writing this in your cheat sheet basically as the formula for this type of question. You add the imputation credit and the dividend, and those will be the income for your calculation for a shareholder's tax liability. And then you would work out how much tax they need to pay based on the marginal income, and then the imputation credit is then subtracted from any tax liability to find the tax that's owed. And you'll be able to see how that works when you do an exercise. And the result of this is that if a shareholder's tax rate is less than the company's 30%, the company already paid a 30% tax on the dividends, so if the shareholder is meant to be paying a lower tax rate than 30%, they're actually going to get some money back. The shareholder would return a difference. If the shareholder was like considerably, really quite rich, and their marginal tax rate was high, so higher than 30%, they'd actually have to pay tax. And if the tax rate was the same, if the shareholder had to pay 30% tax, and that's the same as the company's tax, well, the company already paid the 30% tax, so no tax would be owed. And you'll see how the imputation credit takes care of that. So, example, dividend payment advice. This dividend's fully franked at 30%, so you'll see tables like this. And really the only numbers that you're going to mess around with are here and the marginal tax rates that the question gives you. So we're going to start off with part A, the 15%, a 15% marginal tax rate, and we're finding the after-tax return. So their income for the purposes of this are $379.50 plus $162.64. You have to declare both added together as your income, which is $542.14 in total. Then you calculate the tax liability. They're liable for 15% because of that marginal tax rate. So 15% as a decimal is 0.15 of that income, which is $542.14. And that comes to $81.32. Tax to be paid. And then if you notice in the blue box, the imputation credit is subtracted from any tax liability to find the tax owing. So basically what we worked out is the income is this, $542.14, and this shareholder with a 15% marginal tax rate is liable to pay 15% of that as tax. But the company already paid $162.64 in tax, so they have to take that $162.64 away from the tax liability to see how much the customer really owes. So actually, the tax owing that still has to be paid is going to be negative $81.32, because this is a larger number than this, and it's double. Why does that happen? Because the shareholder, only has to pay a 15% tax on their income, but the company already paid 30%. So the dividends shouldn't be taxed that full 30%, but they already did. So the government has to pay this shareholder back $81.32, which is the extra 15% back that the company already paid. So that's an example where the company is straight up 30%. The company is a straight up 30% tax, but the customer, the shareholder, it only owes 15%. So they actually get money back. They get a negative tax owing. They get money from the government. So that's an example of that happening. If we do an example of the tax rate being higher than 30%, which is B, 45% marginal tax rate. So the income declared is the same. According to the rules, you add them together. So it'll be $542.14. And this time the tax liability is going to be $0.45, 45%, times by $542.14. So the tax liability will be 0.45 times by $542.14. $243.96 to 2 decimal places. So that's how much the shareholder owes, but you need to subtract the imputation credit from this. And I should have indicated here that you minus 162.64. So here it's going to be $243.96 minus the imputation credit of $162.64. That's going to be $81.32 that instead the shareholder owes the government. Well, why is that? Because the company paid 30%, represented by this $162.64, but the dividend, that income, needs to be paid at 45% for this particular shareholder. Maybe they're earning a lot of money. And so the difference is made up by the fact that the customer will need to pay them back because the full amount wasn't already paid. That's opposed to this, where the company paid 30%, but the dividend should only be paid at a tax of 15%. So the government owes the shareholder. So that is working out the tax on dividends. We've shown two scenarios there. One where the shareholder has a lower marginal tax rate than the company rate, and another example where the shareholder had a higher marginal tax rate than the company rate, and you've seen how that works. So hopefully that helps you out with the imputation credits and tax and dividends. and I'll see you on the next video.